Welcome back to the Deep Dive. This week, well, we're looking at a set of sources that really paints a picture of the tension in the global economy right now.
Yeah, it's fascinating. You've got capital flowing like crazy into these hyper-growth areas. Think AI infrastructure, health breakthroughs.
Dizzying speeds, exactly.
Mm.
But at the same time, it's hitting these sharp policy friction points.
Right. Like,
Okay, let's dive in. We have to start with the scale of this AI investment. Nvidia and OpenAI forging this closer, and much, much more expensive partnership.
Nvidia's committing up to $100 billion. That's billion with a B, specifically to OpenAI.
Just for data centers.
Yeah, to build massive data centers using Nvidia's next-gen AI processors. I mean, the scale is just monumental. That's the word Jensen Huang, Nvidia's CEO, used.
Monumental. So what does that translate to in, practical terms?
Well, look at the specs. This $100 billion is funding infrastructure that'll eventually need 10 gigawatts of power.
10 gigawatts. Okay, put that in perspective for us.
Right. To translate that for you, 10 gigawatts is roughly what 4 to 5 million of the high-end GPUs NVIDIA expects to ship this entire year would consume.
Wow, that really puts the scarcity problem into sharp focus, doesn't it?
Absolutely.
Sam Altman at OpenAI basically admitted they're facing three huge challenges: research, product, and just figuring out this insane infrastructure build-out.
It's clear the bottleneck isn't algorithms anymore. It's the physical stuff, building and powering the machines.
Right. It solidifies that link between, the AI dreams and the physical world limits.
And that scarcity of compute power. It's creating huge winners beyond the obvious AI labs. Think Oracle.
Okay, Oracle. How do they fit in?
Well, their stock is up, 85% this year? Mostly because their cloud business has guaranteed access to those critical NVIDIA GPUs.
Ah, the access.
Exactly. And that access just paid off big time. They landed a massive $300 billion contract from OpenAI starting in 2027. Owning the infrastructure, that's the new gold rush.
And you even see this demand reflected in consumer hardware, right? Like Apple.
Yeah. Apple finally erased its losses for the year, turned positive thanks to the new iPhone 17 launch.
The mid-range Air model, the one with the big redesign, seems to be flying off the shelves.
It is. Analysts are tracking really strong demand. Get this. New iPhone 17 shipments are delayed by 18 days right now.
18 days. That's almost double last year's delay, wasn't it? Like 10
That's right.
days.
Exactly. That 18-day lag is a pretty clear signal of strong consumer pull.
Even though Apple was maybe a bit slower on integrating the deep AI features compared to others?
They were, yeah, the last of the mega caps to recover this year. But now they're starting to fold AI in, like the new AirPods Pro 3 doing live translation or the Apple Watch getting better at health risk warnings.
So the point is, data centers or phones, it's all about sophisticated computing demand driving where the money flows.
That's the macro theme, absolutely.
Okay, so speaking of macro themes, let's shift gears a bit.
Mm-hmm.
From Silicon Valley spending to global central banks and monetary policy. We had big decisions last week, U.S. Fed and Bank of Japan.
Right, and showing really different approaches. The U.S. Fed cut its benchmark rate by 25 basis points.
Signaling easing is finally underway.
Yep. And markets loved it. S&P 500, NASDAQ, Dow, all hit new all-time highs pretty much immediately. Cheaper money always helps.
But the really interesting part was the dissent within the Fed.
Right.
It wasn't unanimous.
No, 11-1. Fed Governor Stephen Miron was the sole dissenter, and he argued policy is still way too tight, even after the cut.
Wait, so even with rates at, 4 to 4.25% target range, he thinks that's too restrictive?
That's exactly his point. He thinks that target is actually 2 full percentage points too high. He wanted a bigger cut, 50 basis points, and thinks the rate should be down in the low 2% range.
Why? I mean, for most people, current rates feel pretty high.
Yeah.
What's his justification for saying they're stifling things?
Well, he's focused on this concept, the neutral rate of interest, you know,
Right.
the theoretical rate that doesn't speed up or slow down the economy.
Okay.
Miron believes that because of factors like easing rents and maybe some policy changes like deregulation or immigration shifts, that neutral rate itself has actually fallen quite a bit.
Ah, so the theoretical neutral point is lower,
Sure.
but the Fed keeps rates high.
They're actively putting the brakes on growth. His big fear is that keeping rates too high risks unnecessary layoffs and higher unemployment. He's trying to preempt labor market pain.
That's a really different perspective.
Yeah.
And the divergence is even clearer when you look at Japan, right?
Totally. The Bank of Japan, the BOJ, they held their policy rate steady, just 0.5%.
Despite inflation actually falling there.
Yeah, core inflation fell for the third straight month, down to 2.7%, lowest since late 2024. But they're still cautious. The Nikkei 225 index actually dipped after the decision. Investors wanted easing.
So you've got the U.S. starting to ease, maybe aggressively if Marin had his way, while Japan stays super cautious. Different worlds.
Reflecting deep uncertainty about their own recoveries, I think.
Okay, so friction in borrowing costs. Now let's talk about friction in acquiring talent. That hit budgets immediately this week with the H-1B visa changes.
Oh, yeah. This is policy becoming a direct, immediate cost. The administration announced this, frankly, massive hike in the H-1B visa fee.
How massive are we talking?
It jumped from a range of like $2,000 to $5,000 per applicant up to a flat $100,000.
$100,000 per applicant.
Per new applicant, yeah. And it applies to the upcoming lottery cycle. So companies need to budget for this, like, right now.
Wow. That's staggering for tech and finance. They rely so heavily on H-1Bs, especially from India.
India's 71% of holders. China's nearly 12%.
So what was the immediate fallout?
Instant negativity overseas.
Yeah.
Indian tech stocks slumped almost 3% straight away. Analysts are already modeling maybe a 2% to 4% hit to earnings for the big Indian IT firms, Infosys, Cognizant.
And a logical response for them is?
More offshoring. If skilled labor costs that much more inside the U.S., you move the work outside the U.S. Simple economics.
It just creates such a weird contradiction, though, doesn't it? We're pouring $100 billion into building AI's future here.
Right.
But simultaneously slapping this $100,000 barrier on the skilled people needed to actually design and run it all.
It's the ultimate friction point. Even tech leaders are saying it. Jensen Huang at Nvidia stressed how vital immigration is for attracting the brightest minds.
You can't have tech dominance without talent inflow. Seems obvious.
And look, that friction, it doesn't just stop at corporate balance sheets. It flows right down to the consumer. Our sources are noting consumers generally are feeling really stretched thin, tapped out of credit.
And we actually saw that macro strain pop up in a really surprising place, the U.S. beer market.
Yeah, the rankings shifted. Michelob Ultra overtook Modelo Especial as the #1 best-selling beer.
Which normally might just be marketing, but the reason Modelo's brewer gave.
Constellation Brands, yeah. They explicitly cited weaker demand from Hispanic consumers, a key group for Modelo, and they partly attributed that to the impact of immigration policies on jobs and spending power for that community.
So policy changes affecting visas and border issues, potentially changing what beer people buy. That's a direct line.
It shows how far-reaching this stuff is. It's not just Silicon Valley budgets.
Okay, let's shift again. Where capital is flowing aggressively, health, and how policy is injecting volatility there too. The pharma race for obesity drugs is intense.
It really is. Pfizer just made a big move, acquiring Metsera for up to $7.3 billion.
They needed that right after their own candidates didn't pan out.
Exactly. They had setbacks with their own oral drugs earlier this year, safety concerns. So now they're buying their way into this potentially $100 billion market. They're scrambling.
And Metsera gives them a shot against the leaders, Novo Nordisk and Eli Lilly.
Potentially. Metsera has a pipeline, including a drug called MET233I. It's a GLP-1.
Okay, GLP-1, that's the key acronym here, right? Like Wegovy and Zepbound.
Precisely. Glucagon-like peptide-1. It targets those metabolic pathways. And Metsera's candidate is being developed as a possible once-monthly injectable.
Once monthly. That would be huge compared to weekly shots.
Could be a massive differentiator. So this deal just underscores the intense pressure the capital chasing wins in this specific health niche.
But policy can also slam the brakes on health stocks, as we saw with the Tylenol controversy this week.
Right. Reports surfaced the administration is apparently set to announce a potential link between acetaminophen use in early pregnancy and autism.
And advise women to avoid it unless it's for a fever.
Yeah. And the market reaction was immediate. Kenvue, the maker of Tylenol, their stock dropped 7% on the news.
Wow. They must be pushing back hard.
Oh, strongly. They're citing over a decade of rigorous research, saying there's no credible evidence of a causal link. And the FDA's official stance hasn't changed. They still say it's safe when used as directed.
So it's a government announcement, not even a regulatory change yet, causing huge volatility.
Exactly. Shows the power of that policy uncertainty.
And these friction points, regulatory risk, cost risk for labor, we saw them pop up elsewhere too, right? Media, the courts.
We did. You had the whole Jimmy Kimmel Live suspension ending. Disney basically said it was to avoid further inflaming a tense situation.
Which was triggered by his political comments, threats from affiliates, and even FCC Chair Brendan Carr hinting at license reviews, direct political risk for media.
Yep. And then you had the Supreme Court getting involved with regulatory independence.
Right? Allowing the interim removal of FTC member Rebecca Slaughter.
While the court decides whether to overturn this 90-year-old precedent that protects independent agency heads from being fired without cause. Huge questions about regulatory stability there. Capitol hates that kind of uncertainty.
And finally, on the energy front, a reversal.
Yeah, a federal judge blocked the administration's order to halt Ørsted's big Revolution Wind project off New England.
So construction can resume despite the administration saying they wanted to shut down the offshore wind industry.
Exactly. A win for certainty in renewables, at least for now. It shows that these aggressive policy shifts are meeting real friction in the courts and the market.
Okay, let's try and tie this all together. We've covered so much ground. Capital racing into the future. $100 billion for AI chips, huge demand for the new iPhone, the chase for $100 billion in weight loss drugs.
Massive investments.
But at the same time, policy deliberately creating friction. That $100,000 H-1B fee hitting skilled labor flow, central bank disagreements. And we know consumers are feeling strained. What's the fundamental signal here?
I think the key takeaway really is this widening disconnect. You have truly unprecedented amounts of capital being committed to future tech, to health breakthroughs, billions and billions.
Right.
But simultaneously, political policy is directly targeting the flow of human capital, the skilled people you need for those systems. And consumers, the end market for so much of this, are feeling stretched thin.
So it's an imbalance.
Profound one.
Right.
Policies limiting talent flow seem to work directly against the market forces driving these massive tech valuations and investments.
Which leaves us with a final thought for you, the listener, to chew on. How long can tech valuations keep surging, demanding these $100 billion data centers, if the actual human foundation, the skilled global labor pipeline, is being deliberately choked off with things like a $100,000 entry fee? Really consider how tightly linked those huge capital bets are to maintaining that flow of global talent.